It's a tough market out there for home buyers right now. When it's a strong seller's market and all these multiple bids and you're just not quite finding anything good within your budget. Let's get creative with solutions here. Is there a fixer-upper in the perfect location that could work for you only if you could do some renovations? Or where does that money for renovations come from if you want to just stay put in your own home and make it just right for your family? Add that in-law suite, maybe add that home office or the extra bathroom that is needed. Well, here's Viren Kapadia with some solutions. He works with Citizens Bank and has some loan products that can help. His tremendous experience from when he had a lot more hair certainly is going to help us. Here's my chat with him. Let's hear what he had to say. So, Viren, let's talk renovation loans today. Not every seller that I spoke with, any homeowner, might decide to not buy or sell their home and they want to stay in their current home. The location is fantastic. They have family nearby, or for whatever reason, that location works for them and the house currently works for them. They just need to spend some money and tweak it to suit their needs better. So what is a renovation loan? Tell us a little more about this. We only know about the regular mortgages that people get when we buy homes.
So just as you referenced, people want to stay in their homes. Usually we approach it in one of two options.
Okay.
One is a home equity. A home equity is based on the current equity that they have in their home.
Right.
If they have sufficient equity to cover the construction cost, that's the cheapest and best way to go.
So hang on just a second. So when you say equity, I just want to make it clear. Suppose you have a $500,000 home. I can give you the valuation of somebody's home, right? What is the exact current value, that range? And then we know how much they owe on their mortgage. So the balance between what the value is and the mortgage is the equity that they have in the house.
It's the equity, but so say in your example, they have a $500,000 home and they owe $400,000. They don't have any usable equity. Because the equity is that 20%.
Right, they don't have the money for the renovation.
Correct.
Yeah.
So in that case, let's say they want to add $150,000 worth of a renovation.
Okay, so my in-law suite is going to cost me, the builders told me it's going to cost me $150,000.
Exactly. So what we are going to do is that $150,000 on top of the $400,000 is now a $550,000 loan.
Okay.
That $550,000 should represent 80% of the future value once the work is completed. So where you would be a real benefit to your client is that if they say, I want to add $150,000 and add an in-law suite, your comps to them would...
So then now it is $650,000 or so. The house should be worth $650,000 to be able to...
For $550,000, 80%, $550,000 should represent
80% of the final value, right? So I do get the numbers part of it. I mean, there has to be some kind of common sense check in, you don't want to put $200,000 renovation into a $150,000 home. I mean, really, there has to be that common sense check. But mostly they're doing it to enjoy it themselves, right? They're, homeowners want that in-law suite or that extra office or that extra bathroom or that sunroom in the back. And so if you're breaking open the walls and, doing all this to your home, you want to appreciate it while you live there.
Absolutely.
And there also has to be value in it for a resale.
Correct. Those are the key metrics that you would help the homeowner.
Okay.
Does it make sense?
Yes.
Is it going to give you a return in the long run?
Right.
If it's not going to do any of those things, then maybe what they need to do is start on the search for a move-in ready home.
So that was the other thing I was going to get into, right? So right now the inventory levels are very low, right? So we don't really have enough homes on the market and buyers are a little disappointed because they're not finding anything just right. So sometimes we see some fixer-uppers, homes that need a lot of work, a lot of help, and we could get them to where they need to be, but the buyers may not have the money to put in. So can this loan be used towards that as well?
Absolutely.
Okay.
You can turn around and the time period is a little bit longer. So say if someone wants to buy a fixer-upper, the likelihood of that closing in 45 days is not that strong.
Yeah, of course.
Because when we do the renovation loan, for the appraiser to know what will the future value be, the homeowner or the new homeowner needs to tell us what they plan on doing. They would need to contract with a builder.
Ah,
And
so now
that's-
I have shown this fixer-upper to the clients, right? And we're like, okay, now what if we need a Viren to give us this renovation loan? But before that, we need to find a builder
Correct.
who will give us an estimate on all the stuff that we need done there.
Correct.
And then we bring you that estimate?
Correct. It's not, first of all, bring us, the estimate is there, and then you would take that estimate and see, is it going to be worth what they want to do? So let's assume that happens.
Okay.
The estimate is the start of the conversation.
Okay.
To take it to the appraisal level, that estimate has to become a contract.
Oh,
So
okay.
the contract has to be there so that we know that once we go to closing, there's only one closing that they purchased the home, and then the construction money is kept aside to be drawn on as the work gets completed.
Ah, so my home currently I'm buying it for 500 and we have 150,000 in that contractor estimate and the loan I'm going to get is for 650. I mean, what 550 if I'm putting in 100,000, as a down payment, but I'm only getting so much till I own the home, and then the contractor is contracted to get the rest
Get the
of it
work
as
done.
the work is. So is it paid
Correct.
to him in installments?
That's exactly right.
Ah,
It's paid over time.
okay, okay. So you've decided on the contractor, you've decided on the project, you have the actual numbers, and now you're buying the home, and the bank can take care of it.
Correct. They've moved in. They may not move in right away.
Uh-huh.
They may be, if they're renting, stay in their home till the house is finished. But yes, that's the 30,000 foot way to look at this.
So tell me about the qualification part of it, right? Like, so
Qualification
as a
is-
buyer,
Right, as a buyer is no different
Oh.
than any other loan. It's just we are looking at the higher loan amount.
right?
That's all.
So, but as a buyer, I still need to get pre-approved for that 650.
Correct.
Okay, it's just that I'm buying something, and it makes sense. It sometimes, it's funny as a realtor, not funny, but we put price ranges in our search. And if somebody is looking for a 650 home, we're only looking at maybe 500 to 650.
650, right.
This gives us an opportunity to look at 400 to 550,
Correct.
and maybe there's something there that works that
Right.
could be get to the 650 level.
That's exactly right. If it's if it's the classic diamond in the rough, or it's in an up and coming neighborhood,
Yeah,
that's exactly, this would open up the possibilities
Yeah.
and open up a geographic area for your clients,
Yeah.
all kinds of stuff. So it's a worthwhile exercise. It may not come to anything.
yeah, but no, that's a great option, I think, because we're so low on inventory right now that opening it up from 400 to 650 gives them certainly a lot more options.
Correct.
And I'm a big fan of I'm into real estate is location. Location, lot, floor plan. Those are the things that you can change later.
Correct.
But now with this renovation, maybe the floor plan can be changed.
Maybe the floor plan can be changed.
Yeah.
And one of the other ways to look at this, especially in this market, is that we know that interest rates are high.
Yes.
So another way to approach this, and I've recommended this over the past 25 years, is someone go ahead and buy the home as it is, if it is in livable condition.
Okay.
If they buy it as is, move in, get a feel for the home,
And
and
then
then start to renovate, because you can start to think along the lines of, okay, I thought I was okay with this kitchen, but maybe if you get rid of that wall and do this and do that, that opens it up. So
I
you're
like
not doing it twice.
Yeah, I like that even better. Once you live in the house, you get a feel for it. You get a
Correct.
feel for what you want. And this might be a better option. And it's still called a renovation loan.
Still call it, in this case, there will be two closings. One
Okay.
is simply to
Okay.
purchase a home,
Uh-huh.
and then take your time, 6 months, 8 months, 1 year, however long it takes to move into the home, figure out what's needed, and then do the renovation. So that's another way of looking at it. And if you can get it at the lower price because no one else wants that,
Yeah, well, sometimes those are bargains.
right.
Those homes
Exactly
are always
right.
bargains.
That's exactly
So
right.
I always say the value of the home is in the location, the condition, and what was going on in the market at that time. So you don't have control over the location and you don't have control over the market, but the condition is something that you can manipulate.
Correct, exactly. And if it's in lousy condition today, it doesn't mean it's going to always be in lousy condition.
Yeah,
So-
that's the opportunity to fix it.
Yep.
Well, this was a great opportunity. Thank you for that lesson,
Thank you.
Viren.
You're
So,
welcome.
one more question about interest rates. Would the interest rate for that be very similar to what a mortgage rate
Very,
is?
very similar.
Okay.
If it's an eighth difference,
Okay.
that's all that it is.
Okay.
So, and we invariably do an adjustable rate loan in this environment. Like a 7-year ARM, that's typically what I've been doing on all the construction loans of late, construction and renovation loans. Because we know by the time renovation is done, you can always turn around and refinance it anyway.
So, and now when you're refinancing it, it is the new value of the home, the
Correct.
new appraisal.
That's exactly right.
So 7-year ARM, which means that your interest rates are fixed for 7 years, and then within 7 years you're going to refinance.
Exactly, and it doesn't necessarily mean you will refinance. So depending on what the index and the margin is, if it's going to drop from where it is now, then maybe you don't do anything.
Okay.
But you always, in the year before you are going to get to the point of change, you start to look at options.
Yeah.
So if, for example, if you close today at 7 o'clock, at 7%, you may still, if the rates don't change, now 6 years have gone by, you start to look, am I going to be here for how much longer am I going to be here?
Yeah.
You start to do the evaluation.
That's true. Most people, that's the other thing, fallacy, right? Most people assume your loans are going to be 30 years. Like you may not be alive in 30 years.
Exactly.
Right? I mean, I often think that we're just so used to, our minds are trained on thinking 30-year loans, 30-year loans, 30-year loans.
Yeah, no, the average life of a loan is 6.5 to 7 years, regardless of how long someone lives there.
That's good. That's a good statistic.
Exactly.
Yeah.
That's why years ago when adjustables came out, the 7-year loan became the most popular loan. Or for second homes is generally 5 years. So we would do the 5-year ARM for second homes. And now the 7-year, it just becomes the default loan to go to.
Well, and we're knowing our mutual clients, what we're going to do is probably have them invite us once that renovation is done and go
That's
party with them.
Right. We have some bottles of bubbly we've been storing, so it's time we use them.
We'll come and celebrate that
That's
with you,
exactly
right? The whole
Whether
renovation.
you like it or not.
Yeah. So watch out. Don't get your loans from him because he's going to show up with the bubbly.
We know where you live.
Well, thanks, Viren.
Absolutely.
I always admire you for how you have a solid handle on the logistics and the concepts, and yet you try to break it up in layman's terms for some of us who don't quite get it. So appreciate it.
That's what we do.
Yeah.
That's what professionals do. We make the complex easy.
Yeah.
So
yeah.
that's.
Well,
thanks,
for my audience who doesn't know you, do you want to tell us a little about yourself?
I've been a residential lender since 1988.
Oh, that's old.
Yeah, that's old. I had hair when I started the business. And I thoroughly enjoy it. There's an extrinsic reward and an intrinsic reward. Coming to a closing to see someone, whether it's a first home, second home, fifth home, it doesn't matter, it's your home.
Yeah.
And if that's what we bring, if that's what we make happen, that's really an intrinsic reward. That feels good here. So I've enjoyed this business. I thoroughly enjoyed it. I've financed everything from land loans, construction loans, loans that are what we call cross-collateralized, all kinds of stuff. So thoroughly enjoy it, and working with Bela is always a plus. So
if somebody has to get in touch with you about this, of course they can comment on the video in the comment section below. But do you have a number you could?
Yeah, my direct line is 610-955-6962, and that's the easiest way. You just heard a text go off. So someone's looking for me. It's probably my wife, but yeah, no. Feel free to reach out, and if it's something that, whether you're exploring or something that you are already in the midst of doing, always happy to talk.
That's fantastic. Thank you so much, Viren.
Absolutely.
Thank you for being here today.
Sure.